Okay, let's take a quick look at the agenda. We've got 6 parts today. First, the purpose of these accounts. Then, manufacturing versus trading, defining costs, a step-by-step calculation, some common exam pitfalls to watch out for, and we'll wrap up with a final practice quiz.
All right, Section 1, Purpose of Manufacturing Accounts, the why behind the math. So why do factories even bother making a separate manufacturing account on top of their standard trading and profit and loss accounts? Well, it's actually fascinating how much strategic power this single account gives a business. You see, a manufacturing entity doesn't just buy things and sell them. It literally builds them from scratch. So this account acts like a microscope for factory efficiency. It shows us the absolute exact cost of manufacturing finished goods by breaking down every single constituent element, the materials, the wages, the expenses. And not only does this let us reconcile with cost records to track effectiveness over time, but it's also absolutely crucial for management to figure out employee production-linked bonuses. If you want to reward your workers for high output, this account gives you the exact undisputed numbers you need to do it fairly.
Moving on to Section 2. Manufacturing versus trading accounts, spotting the differences.
If you're taking notes, definitely star this, because it's a major key for your exams. The manufacturing account is entirely focused on the creation phase. It deals strictly with raw materials and unfinished goods, also known as work in progress, to pinpoint your final cost of goods sold. The trading account, on the other hand, it picks up exactly where the manufacturing account leaves off. It deals exclusively with finished goods. Basically, you take the cost output from the manufacturing side, slide it over to the trading side, add in your sales, and boom, you calculate your ultimate gross profit. It's like a relay race between the two accounts.
Now, that brings us to a supercritical term, work in process, or WIP. Picture this. These are the goods literally just sitting on the factory floor right at the stroke of midnight when the accounting period ends. They aren't raw materials anymore, but they aren't fully finished, ready to sell products either. Keep this definition locked in your memory for sure. In your accounts, your opening inventory of WIP is always posted to the debit side of the manufacturing account, and the closing inventory of WIP, that goes straight to the credit side.
That brings us to Section 3, Defining Manufacturing Costs, breaking down the formula.
Okay, with that foundational theory out of the way, let's look at the actual elements making up your total manufacturing cost. Every cost calculation starts with the materials you actually used, not just what you bought. To find your base raw material consumed, you just follow 3 totally logical steps. Step 1. Start with what you already have sitting in the warehouse, your opening inventory. Step 2. Add any brand new purchases of raw materials you made during that period. And Step 3. Simply subtract whatever is left over at the end of the period, which is your closing inventory. Whatever number you're left with represents the exact value of the raw material physically consumed to make your products. Make sense?
So once you have your raw material consumed, you add your other direct costs. Direct costs are, well, exactly what they sound like, costs directly and undeniably tied to producing a specific saleable unit. That includes the raw materials we just calculated, the direct wages paid right to the assembly line workers, and direct expenses. A really great example of a direct expense would be a royalty fee paid for the technology license used to make every single unit, or even plant machinery hired specifically based on the volume of units produced. If it scales directly with the product, it goes here.
Conversely, we have our indirect costs, which are collectively known as manufacturing overhead. This covers absolutely everything that keeps the factory running, but just can't be traced easily to one specific product unit. Think about indirect materials, like lubricating oil for the machines or repair stores. Or indirect wages, like paying the factory security guard or the maintenance staff. None of these folks directly assemble the product, but hey, the product literally couldn't be made without them.
Section 4. Step-by-step cost calculation, putting theory into practice.
All right, grab your calculators, because we're going to walk through a practical illustration to really lock this math into your brain. Imagine an exam question where a factory produces exactly 100,000 units. The costs are cleanly broken down for you. Material cost is 10 rupees per unit, labor cost is 5 rupees per unit, and there's a direct royalty fee to a technology supplier at 3 rupees for every unit produced.
Now, just look at how amazingly simple the math becomes when you categorize everything correctly. Since these are all direct costs linked directly to production volume, you literally just multiply your 100,000 unit volume by each individual cost element. So that's 10 lakhs for raw material, 5 lakhs for direct wages, and 3 lakhs for the royalty expense. Add those whole things up, and you reach your final total manufacturing cost of 18 lakhs. See, it's really just about staying organized.
Section 5. Common exam pitfalls. Let's make sure you don't lose easy marks.
Even with simple math, things can definitely get a little tricky on test day. So let me say this loud and clear. Never ever let an exam trick you into putting raw materials or WIP into a trading account. Those belong exclusively in the manufacturing account. The trading account literally only cares about finished goods that are ready to be sold right now. Mixing these up is for sure the #1 reason students lose points on final account questions.
Another massive pitfall is mixing up direct and indirect costs. Examiners will sometimes list a whole bunch of items and ask you to identify the overhead. Remember this rule of thumb. The moment you see the word overhead, you must exclusively think indirect. Direct materials and direct wages are part of your prime cost, not your overhead. Don't fall for it. Finally, we've got the byproduct rule. Sometimes, a manufacturing process creates a secondary item of really minor value, like wood shavings in a furniture factory. If a question mentions a byproduct, don't panic, because its value is usually pretty insignificant. You just value it at its net realizable value. Then, you simply credit that sale value to the manufacturing account. Why? Well, because selling that scrap essentially acts as a discount, lowering the overall cost of manufacturing your main primary product.
Section 6. Final Practice Quiz. Time to test your knowledge.
Let's see how all this builds into real exam readiness. I actually want you to pause this explainer on each of these next few slides. Think about your answer and really test yourself before I reveal the solution. Okay? Question 1. True or false? The objective of preparing a manufacturing account is to determine gross profit. Got your answer ready?
The answer is false. Gross profit is strictly the job of the trading account. The manufacturing account's sole objective is simply to determine the total manufacturing cost of the finished goods so you can actually assess the cost effectiveness of your factory activities. Okay, question 2. True or false? A manufacturing account is prepared by an enterprise engaged strictly in trading activities. Think back to what we covered regarding the differences between the two entity types.
False again. Of course not. It's right there in the name. Only entities actually engaged in manufacturing activities, meaning those taking raw materials and physically converting them into finished products, prepare this specific account. A pure trading business just buys and sells finished goods, so they get to skip straight to the trading account.
To wrap things up today, I want to leave you with a practical thought exercise. Ask yourself this. If you were the factory manager trying to fairly calculate production-linked bonuses tomorrow morning, how exactly would the structure of the manufacturing account we just learned make that possible? Think about how isolating those direct wages and unit volumes gives you the undeniable, hard data you need. Understand that, and you don't just know how to pass the exam, you know how to actually run the business. Keep studying, stay focused, and I'll see you in the next explainer.